So good afternoon, everyone. My name is James Cook. I am a portfolio manager on JPMorgan Global Growth and Income Investment Trust, which from here on I'll refer to as JGGI. It's our ticker and a little easier on my tongue. So JGGI is a global, unconstrained best ideas strategy. We are looking for the best 50 or so ideas across our research platform, where we cover around 2,500 companies. So if you think about that for a second, less than 3% of the stocks that we look at make the final portfolio, making this one of the highest conviction strategies in the market today. So I want to be clear. I'm not saying that we're the most concentrated strategy. There are the 20 to 30 stock portfolios. But when you look at the investment universe relative to the number of holdings that we have within the trust, this, in our eyes, is one of the highest conviction strategies out there. So please refer back to this slide when I'm done with the presentation. It gives you all the key information about the strategy. What you can see in the top left is some of that information. You can see that we hold anywhere between 50 to 90 stocks, but the reality is we're much closer to the 50 number than we are the 90. To the top right, you can see our performance. We've delivered strong, competitive excess returns, whether you look at the 1, the 3, the 5, the 7, the 10, or since inception. We have delivered incredibly competitive performance numbers. We have a 5-star rating from Morningstar. To the bottom left, you have some of the key features. I think the one that we're going to want to talk about the most is the payout policy. We have a 4% of net asset value payout policy in 4 equal quarterly installments. That, in my mind, gives you a nice balance between growth and income, and that has been very well received with our existing shareholders. And then finally, on the bottom right, you can see what's behind the success of our strategy. It's the resources that are available to us at JPMorgan Asset Management. It's the 80 analysts worldwide. It's the 2,500 companies that we look at, and that's an experienced team. We're going to get into that a little bit more detail later. Now, since this management team has managed this strategy nearly 5 years ago, we have delivered cumulative excess returns nearly 40% above the market. When I update that towards today, we get above 40%. And that's illustrated by the blue line. That's JGGI, 93% cumulative excess returns relative to the broad-based market. That's the yellow line at 55%. But what I've always argued is just as impressive as the magnitude of the excess return that we have delivered is the manner in which we've done so. We've delivered across 3 different style regimes and within each of those regimes. Over 70% of the sectors that we invest in deliver positive excess returns, and we've delivered positive excess returns in every single region. So with that said, today I'm going to take you through why we think investors should be excited by the global stock market, why JGGI and the key criteria that we look for before thinking about investing in a stock, and then finally a bit on performance and positioning. So if I start with why global, if I think about our UK investor base, had our UK investor base been domestically focused, had they considered putting, say, £100 into the UK market, into, say, the FTSE 100, that £100 would be worth roughly £117 today. Overall, for the level of risk that you take, that's a pretty poor set of returns. However, had they considered putting that £100 instead into the global stock market, into, say, MSCI ACWI, that's our broad market index, that £100 will be worth nearly £260 today. That is a substantial pickup in your return. So for those investors willing to look overseas, we think that there is a vast number of attractive opportunities out there for you. Now, one of the biggest misconceptions about investing in the global stock market is that all the best companies can be found in the United States. That is factually false. If you look at the best 50 performing stocks over the last decade, what you can see from the pie chart on the left-hand side is just over 50% come from the United States. The other half come from Europe and developed Asia. So while the US is renowned for having some of the best software, internet, media companies, names like Microsoft, that's been one of the best 50 performing companies over the past decade. We hold it within the investment trust. It's fast becoming the market leader in cloud computing, an area that we see as high growth for many years to come. We believe AI will only make that growth runway longer, but also they arguably have one of the best large language models with ChatGPT. What's impressive about that large language model is, despite being incredibly nascent, it's the speed at which they've been able to monetize that asset. But as I said, not all the best companies in the world come from the United States. Some of the best semiconductor manufacturers come from Europe. Names like ASML, which has a monopoly in shrinking the size of chips. So for all the new AI data centers, all your new iPhones, all of that requires smaller, more powerful computing, all of which is reliant on the technology owned and sold by ASML. But again, if you want to find some of the best industrials in the world, you're going to need to go to Japan. Names like Keyence, which is a market leader in robotics and automation. So if we go through a world of higher wage inflation, that's going to become increasingly important going forward. So to find the best companies in the world, you're going to need to have a global lens. So with that said, let's go through our proposition, JGGI. And at a portfolio level, we have two main objectives. The first objective is to deliver key fundamental characteristics that are superior than the market. First is we want to give you superior quality of earnings. We want those companies with the high barriers to entry, the high barriers to profitability, illustrated by the blue line, which shows that about 80% of our portfolio is in high-quality businesses. That's 30% more than the market. It's one of the highest levels that we've been running at since managing this strategy. We have an enormous amount of data to suggest that these companies bode well through the cycle. But when they really start to perform is when you get a downward earnings revisions, when earnings across the board are coming down, they come down substantially less. And we have a lot of information to believe that's likely over the next several years, in which case this part of the portfolio will bode well. The second part is that we want to outgrow the market. We want faster earnings growth than the market can deliver. You can see that from the green bar that we believe we can outgrow the market's earnings by 3% a year. That is a substantial pickup in earnings growth. Again, one of the highest levels that we've been running at since managing the strategy. And then finally, we want these characteristics and we want them for free. We want to either have a similar, if not better, valuation than the market, illustrated by the purple line. Now, right now, we're a little bit behind on the free cash flow generation, but that is largely because performance of the strategy has been so good. We will be looking to constantly look for new ideas to pick that back up. But if we can trade at a similar valuation, if not better valuation than the market, have superior quality of earnings, and outgrow the market, it implies we believe we've been underappreciated by the market. Now, again, this sounds incredibly simplistic, but the reality is it's very difficult to do. less than 3% of the companies we look at can offer you all three of these characteristics. So to build a portfolio like this requires an enormous amount of breadth of ideas. And that is the advantage of investing with JPMorgan Asset Management. It's the 2,500 companies, which means we can build this type of portfolio. Now, if we can achieve objective 1, it takes us a long way to achieving objective 2, which is to deliver strong excess returns independent of the macro regime that we're in. So, from 2019 to the end of 2021, I should say, by the way, this is the period at which this management team has managed this strategy. So from 2019 to the end of 2021, we saw the growth stocks outperform value stocks, illustrated by that blue line going up. Your growth stocks, that's your software, your media, your internet names. Your value stocks, that's your banks, your utilities. And over that time period, JGGI managed to outperform the broad market by over 8%. Then in 2022, when we saw signs of overheating, we saw inflation picking up, interest rates picked up, and the value stocks began to work, illustrated by that blue line coming back down. And yet again, we managed to deliver nearly another 8% cumulative excess returns above the market. Then finally, with the launch of ChatGPT in December 2022, we've been in another AI-fueled growth regime, illustrated by that blue line going back up, all the way to present day. Now, if I updated that bottom right number to today, it would say roughly positive 8%. So yet another 8% above the market, illustrating that our stock selection has been independent of the macro regime that we're in, and I believe that makes us uniquely attractive to our shareholders. So, how do we go from the 2,500 companies down to the best 50 or so ideas? And for JGGI, we have a simple 3 key criteria checklist. The first is that we need to see significant valuation upside in the stock. And at the heart of our philosophy, we believe that the value of a company is driven by its long-term earnings power and the quality of its cash flows. So once our analysts have forecast the long-term earnings power, once they've valued the quality of those cash flows, we get an expected return. We get an expected return for each one of the 2,500 companies we look at, and we're naturally looking to buy the stocks with the highest expected returns. However, we appreciate that undervalued businesses can remain so for prolonged periods. And therefore, we want to have clear insight into what will make the stock work. Where is our edge, and where do we differ from the market? Now, insight's incredibly important for fundamental portfolio managers, because all the companies, even the best companies in the world, will go through a wobble. And it's important for us to be able to separate those that are wobbling on a short-term issue that are typically going to give us a valuation opportunity to add, versus those that are wobbling on a long-term investment thesis crack, which arguably we need to get out early. And again, we have plenty of data to suggest our ability to trade around that has been very additive to the performance of the portfolio. And then finally, you can have all the insight into the business, you can have all the valuation upside, but if the company doesn't control its destiny, it can all be for nothing. So we want to have high conviction stocks. And what I mean by that is companies that do control their destiny. So we want to have those high quality companies so that they're not at the mercy of their competition. We want them to have resilient earnings so that they're not at the mercy of the economic cycle. And we want them to have an incentivized management team that's there to work on behalf of you as shareholders. That then takes us from the 2,500 companies down to the best 50 or so ideas. And just to reiterate, that is an incredibly high hurdle. Less than 3% of the companies we look at make the final portfolio. Now, behind the success of this strategy has been a partnership between the portfolio managers and the research analysts. So here you've got the portfolio management team, the global equity portfolio management team at JPMorgan Asset Management. We manage 3 key strategies and over $40 billion in assets. The JGGI portfolio management team is highlighted here in blue, and between Helgi, Tim, and myself, we have nearly 70 years of experience, all of which is in fundamental investing. All 3 of us have been research analysts. Helgi has also been a director of research, the head of global research, and we've all managed global portfolios for over 7 years. But the other important point is that we are integrated into a broader network of PMs. Covering global stocks is difficult. There is an enormous amount of ground you need to cover. It's the 2,500 companies I keep referring to. One of the advantages of a portfolio manager is that they can simplify an investment thesis in under a minute. So if I want to go and review a stock that I've been looking at, typically it can take an analyst 30 minutes of reviewing it with me before I've figured out I shouldn't have wasted my time. A portfolio manager can tell me in a sentence, don't waste your time on that. That is a huge help in getting us to cover those 2,500 businesses. Now, I joke about the research analysts, but the reality is they are at the core of our stock picking success. It's about the breadth and depth of research. So let's go through each of those. If I start with the breadth of research, we have 80 analysts worldwide, in the US, in Europe, in Japan, in the emerging markets. Each analyst will cover a sector within a region. So we have a European banks analyst, a Japanese banks analyst, a US banks analyst, and so on. If I want to speak to someone on Chinese property, I have Ravi Tanna, based in London, to do so. Each analyst covers roughly 30 stocks. That's what gets us to our aggregate coverage of 2,500 companies. We make over 5,000 company interactions a year, and JPMorgan spends over $150 million on its fundamental platform alone. That breadth of research is unrivaled. But it's also about the depth of research. So at JPMorgan, we are looking for career analysts. Those are analysts that want to spend their entire careers just researching companies. That's different to many of our competitors, where typically an analyst is used as a stepping stone to becoming a portfolio manager. We don't want that. We want our analysts to be industry experts. The average number of years of experience of an analyst at JPMorgan Asset Management is 19 years. Simon Ponce is our European banks analyst. I've known him from the day I joined 17 years ago. He has 30 years of experience, all of which covering European banks. He was there for the 2000 tech bubble. He was there for the 08-09 financial crisis, the European sovereign crisis that followed, and then COVID. His insights have been invaluable in helping us to navigate those markets, finding attractively valued banks with stable balance sheets. So, that was the research team. Let's now take a look at performance and positioning. If I start with positioning, here you can see our positioning relative to the market across the core universe. So at the top, you've got the high growth cohorts. You've got your tech titans, you've got your silicon stars, that's your semiconductor cycle. On the left-hand side, you have the defensives in blue, and on the right-hand side, you have the cyclicals in purple. So I'm going to make 3 key points. The first is that we are overweight the high-growth stocks. But you can see it's the high-growth cyclicals that we're really overweight. We'll come back to that in a minute. Second is that we are overweight defensives, because that's where valuations are currently most attractive. In particular, it's the quality defensives, what we call the steady stalwarts. That's names like Chicago Mercantile Exchange, where we see macro volatility going forward, rising up from the current levels that it's at, and they will benefit in their transaction volumes. And then finally, we're most underweight to the low-growth cyclical part of the market, because that's where we're most concerned around earnings. There's still plenty of COVID excesses within that part of the market. So if you think about pre-COVID, from 2011 to 2019, global profit margins were consistently at 11.5%. They fluctuated no more than 1% either side of that number over that 9-year period. COVID hits, we get record stimulus, we get record demand, and at the same time, we get supply constraints. Now, any macro textbook will tell you that that combination will result in profit margins increasing. And that is exactly what happened. Profit margins got to peak levels of 15%. Then by the middle of 2022, supply began to ease. And on the back of that, we saw a leg down in profit margins to the tune of around 1.5%. Now, consensus believes profit margins are going to go back to peak and then surpass it. We think that's unrealistic. We don't think demand has normalized yet. We think when demand normalization takes place, then more likely than not, we're going to have another leg down in profit margins. Where that's most in focus, because this isn't going to impact every stock, every sector equally, as I say, where that's most acute is in the low growth cyclical part of the market. So think about your industrial cyclicals that have been beneficiaries of the fiscal stimulus. Think about your consumer cyclicals that have also been beneficiaries of all the checks that have been handed out during COVID. Think about the autos, where supply constraints meant none of us could get hold of a car. Second-hand car prices went through the roof, and OEMs made a killing on the back of it. Once inventories rebuild, once demand normalizes, supply, as I say, has largely normalized, we think those profit margins come down, and that's going to be painful for this part of the market. Think about your banks that sit in rate beneficiaries as well. They've benefited enormously from the higher interest rates. Now we sit in two worlds. Either interest rates stay where they are, but provisions increase, in which case profits come down, or interest rates come down and profit margins come down. But again, we don't want to give you just a purely defensive portfolio. We want to give you a balance between defensives and cyclicals. So within the cyclical arena, the part of the market that we're most excited about is that top right part. That's the silicon stars. That's your semiconductor cycle. Think of your NVIDIAs, think of your AMDs, your Samsungs, etc. This part of the market has been over-investing for several years. The capital intensity has gone up. But what we think happens next is that AI results in better volume growth. Whether that's CPUs, GPUs, or memory, doesn't matter. It's going to come across every part of the semiconductor cycle. And at the same time, capital intensity, we think, comes down to more normal levels. That combination of the two should result in much better cash generation of these businesses. And at the same time, these are high-quality franchises. For most of it, they're working in oligopolies, duopolies, or monopolies. They have real pricing power when that volume growth comes, and we have seen that already. So, finally, on to the top 10 holdings. I'm going to make 3 points again. The first is that this is a highly concentrated, high-conviction portfolio. These top 10 holdings make up about 40% of the entire portfolio. The second part is that we're not putting all our eggs into one basket. We are playing a broad number of attractive opportunities. So whether you look at Amazon, where we think the margin potential can go much higher than where we are today, all the capital that they built, all the warehouse distribution facility centers, means that their ability to service next-day delivery has improved. And we know from history, next-day delivery comes with better pricing and better volumes, which should improve the margin. But they also have cost-out programs that they're executing particularly well that further will improve the margin potential of this business. Second to that, we have MasterCard. So as we go from a cash to a cashless society, we still see reasonable levels of growth within that business, particularly within the emerging markets. But don't forget that the most developed market in the world, the United States, 30% of payments are still done via cash or even the archaic check. So, still think there is room to grow there. We've talked about Microsoft already, cloud computing, winner, AI winner. And then finally, I'll just touch on perhaps a European name, LVMH, that's tapping into that middle income demographic growth that we're getting from the emerging markets. Again, substantial pricing power there. And then finally, just to also add, these companies are the market leaders in the industries in which they operate. So if we go through a world of higher cost inflation, we think these companies have the ability to price for that. And then finally, just to finish off with performance. So again, just to reiterate, we are proud to say that we've delivered strong performance numbers, whether you're looking at our share price, whether you're looking at the net asset value growth over the 1, the 3, the 5, the 10 since inception. But again, we talked about the power of compounding since this management team has been in charge, but also take the 10-year number. We have performed cumulative excess returns over 70% above the market on the 10-year number. So with that, just want to say thank you very much for listening, everyone. I will be at the booth towards the back if you have any questions for a short period. Thank you very much.